This is the most profound statement in this lecture. Dividend is a return of capital, not return on capital. This will hold you in good stead. Howdy guys, welcome back to the Honda Show. One of the videos we recently posted was about pros of dividend investing. Today I'm going to tell you the cons about dividend investing. There are a lot of pros about dividend investing, but there are also cons about dividend investing. And I think like everything in life, you need to know the pros and the cons so you are making a good guess and not just winging your investments. Also knowing the pros and cons of everything helps you invest better with your eyes completely open. You're not just enamored with some particular asset class and then you end up underperforming the markets. The cons of dividend investing, I have divided this lecture under 4 or 5 sections. So in this way, we cover one section at a time and it is more structured. You don't lose track of what I'm talking about and you're also able to retain it better. Let's talk about return of capital. Most people, when they think about dividends, they think of dividends as something that they're getting extra on top of the price appreciation, but that's not a good way to look at it. Dividends, they are a part of the total return that a stock provides. It's not something on top of the performance of the stock and then you have dividends. No, it's part of the total picture. You can have a stock that gives you 7% return annually, or you can have another stock that gives you 5% return annually and a 2% dividend. How does it matter to you? It's still 7%. In fact, in the second instance, it's not as good because on the 2% that you get back as dividends, you owe taxes on it. Whereas in the first instance, if the company didn't pay you any dividends and it made 7% and reinvested the money in business, you don't owe any taxes on it and your money gets to compound tax-free. Effect of change in dividend. Unlike interest on a CD or a bond, dividend is not a contractual thing. As an equity investor, you stand last in line to get your money. When the earnings come in, the bondholders are ahead of you, then you have the preferred share people, and then you have the common equity people. If you are in an economic downturn like what we are recently going through, you can be in a situation, especially in companies which are deeply cyclical or cyclical companies in which the earnings tend to drop drastically. In situations like these, you can be in a situation in which the dividend has to be cut. And as soon as the dividend is cut, because there are a lot of people who are in it just for the dividends, there's a huge wave of selling that happens. So in this situation, you can have a 3% dividend, but you can lose 40% of the value of the stock. It's going to take a long time for it to recover. So dividends, are they really that good? Many people believe just because you buy a dividend stock, it's a safe option. But having dividends or not having dividends doesn't make anything safe or unsafe. Like everything in life, dividend stocks, they come in different shapes and sizes. Always be wary of dividend traps because when stock prices they drop drastically, like you have oil companies which have gone down drastically this year, the dividends can seem very enticing till the point they get cut and now you are trapped in that stock. This is called a dividend trap. Hence, I always keep saying when you buy dividend stocks, you only buy in sectors which have a very consistent, predictable earnings like REITs, utilities, premium alcoholic distillers, and finance. Their earnings don't tend to be inconsistent, and even in terms of economic distress, they have consistent earnings and they can keep making those dividend payments to you and your stock is not very volatile. When buying dividend stocks, try to stay away from cyclical and deeply cyclical sectors like steel, mining, home builders, car manufacturers, unless you have a profound understanding of those sectors and you are buying stocks at the low end, and then you can make up the money as the stock prices go up. But for most people, they should not be in cyclical and deeply cyclical sectors. Taxation. Most people don't understand this, but when a dividend is paid out, the stock price, it goes down by an equivalent amount. Just to give you an example, so if the stock is $10 and it pays a dividend of $2, the very next day, the stock should trade at $8 and you owe taxes on the $2 that you got as dividends. So what profit did you make? Depending upon what your income is, depending upon what your tax bracket is, you owe taxes on those dividends, on the ordinary dividends that is. So in effect, you are being taxed twice. First, as a shareholder of the company pays taxes on the earnings. And then when it pays dividends to you, you pay taxes on those dividends. So you're taxed twice for no reason. Besides the taxes that you have to pay as a shareholder of the company, as an individual of the company, if you buy a stock that's listed in some international stock exchange, you also have to pay withholding taxes on that stock. Depending upon the country, because you have these bilateral agreements between the countries and they beat out a tax rate. So depending upon where the stock is listed, you owe withholding tax on it. The withholding tax can range between 0% to 35%. So the company pays taxes, then you pay withholding taxes. Let's just assume you pay 35% in terms of withholding taxes. Then you pay income tax on top of the dividends. That is some serious loss of capital. Now, I would not like to buy that stock. And if you only focus on companies that pay dividends or increase their dividends every year, you miss a whole host of companies. You miss a complete universe of stocks like Amazon, Google, Berkshire Hathaway, even Microsoft. During its growth years, you would have never touched it because they didn't pay no dividends. But that's your loss. Adverse effects of high dividends. When you buy a dividend stock, always keep an eye on the payout ratio. Make sure the payout ratio doesn't cross 80% of the company's earnings. Because sometimes to make up for reduced earnings, the companies, they even borrow money to make up for the shortfall and pay you dividends, which is not a good sustainable position to be in. I mean, in today's world with the interest rates, how low they are, it's a very tempting situation for most corporates to buy money, to issue some bonds, pick up money at extremely low rates, and then issue them out as dividends. But you don't want to be part of those companies. Like this year when the pandemic struck, a lot of companies in the aerospace sector, in the airline sectors, they were in deep trouble. Why? Because when the times were good, they indulged in billions of dollars worth of buybacks, gave millions of dollars worth of bonuses and incomes to the top executives. They gave huge dividends. And when the business went down because of the pandemic, they were in a very precarious situation. They didn't have enough money and they had to go in front of the government begging for a bailout. All because their payout ratio, if you included the buybacks and the dividends, were way too high and very unsustainable. If you have identified a good company like say Visa, which can earn return on equity above 30% on a consistent basis, you would prefer them not to give you dividends and reinvest that money and earn that 30% on the equity, because you yourself, if you go out hunting, it's very hard to come across anything that gives you 30% return on equity on a consistent basis. So companies like these who earn huge returns on equity, if they give out dividends to you, your total return is actually going to be lower. Many investors, they look at dividend investing to generate some income, which is a fair deal because you have one less decision to make. You don't have to time when to sell the stock, the dividends just roll in and you have less thinking to do. But just because you're trying to generate income, don't reach for those high yield stocks just because the yield is very high. Usually when the stock has a very high yield, there are two problems. Either the company is in serious trouble or the whole sector is in serious trouble, and usually the markets are right. These companies, they don't really have an opportunity to invest their retained earnings. Sometimes high yield can also be used as a bait by the companies. They try to do that to sell some equity, to raise capital in a company that is otherwise failing. Dividend versus capital appreciation. Dividends, they are a return of capital. They are not return on capital. Say this to yourself a few times so it becomes part of your thinking. If you take nothing away from this lecture, this one line, just say it to yourself a few times. This is the most profound statement in this lecture. Dividend is a return of capital, not return on capital. This will hold you in good stead. Even Warren Buffett subscribes to this theory, and that's why he doesn't pay you any dividends. And he encourages his shareholders to sell small pieces of stock to generate their own income. It's way more efficient this way. As an investor, you can outperform the markets by not focusing on dividends, but to focus on value and quality. Instead of just focusing on dividend stocks, it would be way better for you to invest in quality companies during the times when they are undervalued, and then generate your own income by selling small pieces of stocks as and when you need the money. Alright guys, now let's get down to the end of the video. Let's conclude the video so you have all the salient points, you don't miss nothing, and you don't make any mistakes in your investments. Do not just focus on dividends. Price appreciation is the only source of capital accumulation over time. Say this to yourself. This is the second time I'm saying it, but say this to yourself. Let this sink in. It's a very important statement. Dividends are not return on capital, but they are return of capital. When you get a dividend, you have to pay taxes. Even when you put that money back into the stock, you haven't really put all the capital back because you've lost some capital because of taxes. So it's not a very efficient way to invest. Dividend paying companies, they see less price appreciation because they have capital taken off their books all the time because of paying those dividends. You can have significant erosion of capital values if for some reason the dividend is cut or not paid at all. As an equity investor, your claim on the earnings is at the last, after the bondholders and the preferred equity holders are made whole. Tax rates right now are at decadal lows. If the taxes go up, dividend stocks will become less attractive. This can lead to huge re-rating of dividend stocks and their P's to go down considerably. Alright guys, that's it for today. These are all the cons that you need to know about dividend investing before you make that jump into dividend stocks. If you found this video useful, please give me a thumbs up. If you have a friend or somebody you think who would be interested in dividend stocks, dividend investing, or investing in general, please share the video with them. If you have any comments, any questions, please comment down below. And if you haven't subscribed to my channel, please subscribe to my channel. I will do my best to get good content across to you. See you in my next video.